What's up, everybody? Today, in a quick 2-minute video, I want to go over why exactly life insurance can actually be a phenomenal way to generate cash flow throughout the rest of your life that does not trigger an income tax. Okay, before we get started, I want to compare this to traditional financial planning. So I'm going to do some drawings, quick video. Hopefully you get something out of this. Check this out. All right, let's say that you have a liquidation event in the next 3, 5, 10 years. Either you sell a business, you get an inheritance, you sell a bunch of real estate, whatever it is, your money is working for you in the market so that you can generate the highest rate of return possible, whether that's in your business or real estate, whatever. The question is, when you exit that entity, how do you have your cash flow generated for the rest of your life? Well, traditional financial planning says, let's say you have $1 million liquidation event. So you got $1 million to put somewhere to work for you. Well, if it goes in the market, we all know that the market goes up and down. Hopefully over time it's going to go up, which it generally speaking has. But you also have these moments of negative returns. And in retirement or later in life, as you're relying on that money to generate cash flow for you, it really hurts your ability to take money out because you're taking money out and the market has dropped. So you don't have as much money inside the account to actually rebound back up. And if you're interested in that, Google sequence of returns in retirement. Now, I'm not a huge fan of the word retirement because I think any business owner, entrepreneurial minded person is never going to actually sit around and play golf all day, but your money has to sleep somewhere. And I personally do not want my money to sleep in a place that can lose value. I want to be able to take advantage of the upside. That's why insurance is so powerful. So while you have your business and maximizing your rate of return, let's say that in 5 years or 10 years, you actually sell your company for $1 million. How can you then take advantage of what Albert Einstein called one of the greatest wonders of the world? And that is compounding interest. See, what's unique about life insurance is if it's properly structured, you have guaranteed no loss. Now, the rate of return is not phenomenal. Okay, you can get a better rate of return elsewhere, but you also take on more risk. So by putting money into an insurance contract, I guarantee no loss and I have very little risk, which means it's like the tortoise and the hare. It's just slow growing forever. And the part that's unique with life insurance is that they're going to pay dividends. If you structure this correctly, they're going to pay dividends even when you're taking money out. Okay, so in retirement years, as you're taking, or as you get older, as you're starting to take money out for whatever it is, it could be investing in a new company, it could just be living off the cash flow. The dividend is paid on the gross amount of cash flow, which does not recognize the money being taken out. Okay, so here's what's beautiful about how we can structure this with life insurance. The same way that a bank pays for your house, you have a mortgage. Ideally, the value of your house is going up over time. The fact that you have a mortgage has nothing to do with the value of the house. Well, same thing with life insurance. And so if your money can do better for you inside your business or whatever you're doing, that's where your money should go. Let somebody else then pay the life insurance premiums, just like I let somebody else pay for my house. So I let the bank, in this example, put in $100,000 a year for 10 years. Boom. So over 10 years, I have $1 million in that policy. Now, here's why people don't like life insurance. I put $1 million in and I have $1 million. That's not a great rate of return. It's horrible compared to what you're getting elsewhere. So just like I let the bank pay for my house, I'll let the bank pay the premium. What I've created now here is a $1 million loan. So whenever you sell the company, or if you don't even sell the company, you'll have $1 million in cash value. You take the cash value out of the policy, pay off the bank loan. The $1 million goes to pay off your bank. Now you've created a massive void inside the policy where there's $1 million hole. Now, cue you selling your company. What are you going to do with the $1 million? Well, you could put it into the market and gamble with it, lose control, have subject to market volatility and possibly future taxation, whether that's income tax or capital gains tax. Or I put the money into the policy, which was in the massive hole that I created by letting the bank pay for it. So when I dump in my $1 million into the policy, the insurance company continues to pay dividends on the full $1 million. And because they're paying dividends on that gross amount, it does not affect the amount that I can pull off each year as I get older. So now I'm taking advantage of compounding in the part where actually I see the most growth in the policy. It's liquid. I can use it for whatever I want, whether it's investing in another company. And the key point here is that you're taking advantage of the latter years of compounding interest. If you want to learn more about how to set this up for yourself, click the link below and set up a free 30-minute consultation, and I can walk you through if this is something that will work for you.